Welcome to TP Talks, PwC Global Transfer Pricing podcast series. My name is Ugo Cannavale. I'm a PwC partner based in Milan, Italy. I want to welcome our listeners to our next episode, where we will continue the discussion of the OECD G20's implementation of Pillar 2. In our first episode, we provided an overview of the rules addressing some of the complexities and the role of transfer pricing. In part 2, we discussed the Pillar 2 commentary on model rules, published in March 2022, the UK stakeholders consultation, and the changing role of transfer pricing under Pillar 2. Today, we plan to kick off with an update of the global tax policy landscape, the progress of Pillar 2 over the last several months, and the implication for transfer pricing. Let me introduce our speakers. Back on the podcast, we have Giorgia Maffini, PwC UK. Giorgia formerly served as the deputy head in the tax policy and statistics division at the OECD, and currently is a tax policy and transfer pricing director with PwC UK. And Kartikeya Singh, a TP principal with PwC US National Tax Practice. Welcome to both of you. So, to get started, Kartikeya, the global tax policy landscape has changed dramatically since our last podcast. Can you level set and bring our listener up to speed on what has transpired?
Thank you, Ugo, and hello, everyone. That's right. When we last spoke on this, work on Pillar 2 had already outpaced that on Pillar 1. And like you mentioned, we had the model rules, we had the accompanying commentary explaining those rules with examples, etc. And this covered the entire gamut of the concepts, the building blocks, covering the income inclusion rule or the IRR, the UTPR, the undertaxed profit rules, which in its original version was the undertaxed payment rules, but now it's still only known as through its acronym, the UTPR. And it also had discussion on a lot of the additional new concepts that have been added on, at later dates, like the qualified domestic minimum top-up tax, the QDMTT, etc. Lots of acronyms here to work with. But there were still many open questions. A big one that we saw for US headquartered multinationals was around GILTI and how GILTI would be treated. Would it be a Pillar 2 compliant regime? Would it be treated as a CFC regime? And then how would the rules work to account for that one feature in GILTI that had been the source or the center of all the uncertainty surrounding it, right? This was the worldwide blending as opposed to a jurisdiction by jurisdiction application that is there in Pillar 2. And suffice it to say that since then, developments in the Pillar 2 space have very much kept up that momentum. We have a number of new documents and materials issued by the OECD and the Inclusive Framework since our last podcast. And I'll cover a few that were released late last year in December. And so starting with those documents, the first one is guidance on safe harbors and penalty relief. So this includes a transitional safe harbor based on country-by-country reports, CBCRs, which should be of particular interest to us transfer pricing practitioners, because that's an area that we've been working with many taxpayers over the last several years. The guidance also includes a framework for a more permanent safe harbor, a simplified calculation safe harbor. The second document that came out late last year was a consultation document on a tax certainty framework for Pillar 2. And this document recognizes, and the gist of this document came from a recognition around the inherent complexity of the Pillar 2 rules, and that they could be interpreted and applied in different ways by different countries, giving rise to uncertainty on the part of taxpayers. And the purpose of this document is to explore mechanisms to provide that tax certainty with respect to the Pillar 2 rules. And the third document that I wanted to mention that came out late last year is also a consultation document, one on the Globe Information Return. And this document was intended to develop a consistent and transparent set of standards for information collection, all with the purpose of having what was supposed to be a standardized globe information return that was called for in the model rules.
And Kartikeya, what is the development this year?
Yeah, great question. That was everything that we had late last year, and we've had a pretty significant development early this year in February, where we got to see the administrative guidance released by the OECD. And this guidance addresses also a wide range of issues and questions that were identified by Inclusive Framework members that needed clarification and simplification. And the expectation is that this guidance will be incorporated into a revised version of the globe commentary and the examples that I'd mentioned earlier, that a previous version of which we discussed in our last podcast. And among the different things that are covered in the administrative guidance and stuff that is extremely important to, the open questions that were important to US taxpayers in particular, is that the guidance confirms the status of guilty as a CFC tax regime under the Pillar 2 rules. It also provides a formula, a mechanical allocation formula for guilty and other so-called blended CFC tax regimes. Remember, the whole issue with guilty was that because it applies, this sort of a minimum tax test on a blended worldwide basis, how would you go about attributing those taxes on a jurisdictional basis as needed to apply the Pillar 2 rules? So there is a formula for that in the administrative guidance. And then finally, there is guidance also on the QDMTT that I'd mentioned earlier, the Qualified Domestic Minimum Top-Up Taxes. So this is all the set of documents, at least the important ones that we've seen from the OECD and the Inclusive Framework. And then you have developments at the country level as well as the EU level. So in short, a lot of movement, a lot of developments since our last podcast.
Thank you, Kartikeya. Giorgia, for those of us not fully up to speed from a TP perspective, what role does transfer pricing play in the landscape of Pillar 2?
Hi, Ugo, and thank you for the question. It turns out, Ugo, that the arm's length principle really has a key role in Pillar 2, and we touched upon this in the previous podcast. So essentially, the model rules give a central role to the ALP by saying that all transactions need to be adjusted at arm's length when you calculate your globe income under Pillar 2. It turns out that this rule is quite impractical when you really apply that, because it would require you to adjust all transactions that takes place in a multinational to the ALP. And many of our listeners will know that there are very good reasons sometimes for not booking transaction at arm's length. For example, you're using a safe harbor, or you're operating in a country where there is a mandated return that is above the arm's length range. So because of these difficulties, we saw that the guidance and later the UK draft rule gave us some more pragmatic rules. So the Pillar 2 rules moved from a very theoretical approach to a more pragmatic one. And we are told by the guidance, by the UK draft rules, that you need to adjust your transactions at arm's length only under certain circumstances. So the set of adjustments that you have to make to calculate your globe income is now much smaller. But it's still, I have to say, Ugo, very complicated. So it's a very complicated topic because you need to check whether there are differences between your tax return and the accounting data you use for your consolidated statement. Then you need to check if you are in a high tax jurisdiction or not. So overall, we remain in a pretty complex environment, and it's very important that transfer pricing professionals are involved in the Pillar 2 calculations as well. But I think that as we understand the rules better, and essentially we test them against the facts and circumstances of real businesses, we are turning our attention more to the implication of Pillar 2 for transfer pricing. And we are discovering that there are some truly important transfer pricing issues that really transfer pricing professionals should be aware of. And we have tried to divide these issues in 4 buckets. The first bucket relates to CBCR. The second bucket relates to year-end transfer pricing adjustments. And so we all know that the calculations for the globe income start from the figures in your consolidation pack. And if the year-end transfer pricing adjustments are not included in that consolidation pack, then there is a question of how these transfer pricing adjustments should be treated for the purpose of calculating globe income, so the denominator of the Pillar 2 ETR. It turns out that however you respond to this question, and it's still a bit uncertain, you really could complicate even further your compliance with Pillar 2. And therefore, you, as a transfer pricing professional, I think you may want to consider a change in the timing of your year-end transfer pricing adjustments and make sure that they flow through your consolidated statement. Otherwise, your Pillar 2 compliance becomes very, very difficult. The third bucket of transfer pricing issues deriving from Pillar 2 relates to audit. So imagine the very common case in which you have an audit in a high tax jurisdiction on a transaction between that high tax jurisdiction and a low tax jurisdiction. Now, we don't have time to go into the details of that on the podcast, but it turns out that an audit in the high tax jurisdiction that increases your income, so an upward transfer pricing adjustment, implies double taxation because you have already paid top-up tax in the low tax jurisdiction and then you pay tax on the same adjustment in the high tax jurisdiction. So really, the message here is that getting your transfer pricing wrong in a post-Pillar 2 environment will be much more costly than it was before. So you really want to make sure that your transfer pricing policies are correct, they are in line with your facts, and that they are well documented. Otherwise, again, the cost of getting all these things wrong will be higher than it was before. And the last bucket of transfer pricing issues arising from Pillar 2 is related to your value chain. So depending on how countries will react to Pillar 2, it may be important to reassess, to reevaluate your, say, principal structure, your profit split. And around in this area, I think there will be a lot of uncertainty for some time. So you might need to run different scenarios. And there will be uncertainty because countries will react differently to Pillar 2. Some countries will apply the qualifying domestic minimum top-up tax, for example, in the UK, in Germany. Other countries will apply a purely domestic tax that maybe is not qualifying and operates a little different from the qualifying domestic minimum top-up tax. And other countries won't do much until it's clear whether the under profits rule will really be effective. So really, it's quite important to think about your value chain and how Pillar 2 and the changes triggered by Pillar 2 will affect it. And because Pillar 2 has been thought to affect your value chain, so because Pillar 2 wants to reduce tax competition among jurisdictions, some jurisdictions will become less competitive, essentially.
Thank you, Giorgia. Kartikeya, coming back to you, I want to ask you about the Pillar 2 safe harbors that you mentioned, in particular the transitional CBCR safe harbor. Can you explain what it is?
Yeah, sure thing. And I'll back up a little bit and go back to the Globe information return that I'd mentioned earlier. When you look at the consultation document on that Globe information return, the one immediate thing that becomes very evident very quickly is that This is going to require taxpayers to collect a lot more data and information than what they are currently used to. So in other words, from an administrative compliance standpoint, this is going to create a significant additional burden, notwithstanding all the claims around simplification and consistency and simplicity. This is going to need taxpayers to track historical tax, non-tax information, and a number of other data points and information items that are very different from what they've had to do to meet, the local tax compliance in all the jurisdictions that they operate. And remember, many of these companies are going to have tens and more than 100 jurisdictions where this global information return is now going to be applicable, and those data points are going to be needed. So significant additional compliance burden and information needs in a Pillar 2 world based on what's going to be needed for this global information return. Now, what the transitional safe harbor does, and the transitional word is important because it's a temporary opportunity, but it's an important opportunity for taxpayers because it provides them much needed relief from this compliance burden, at least for some jurisdictions. And so it provides an opportunity and a potential breathing space for taxpayers to avail of this safe harbor for a set of jurisdictions while they continue to invest and develop the much higher resources and capabilities that they will certainly need, either in-house or through external support, in order to comply with that global information return requirements in these various jurisdictions in a Pillar 2 world. So how does the transitional safe harbor work? Well, as the name suggests, it is based on the country-by-country report, the CBCR. And so in theory, it works off of data that clients and taxpayers are already preparing and for which they have the systems and processes because they're already preparing their country-by-country reports. The caveat in all of this is that in order for you to avail of the safe harbor, the country-by-country report that you're relying on must be a qualified country-by-country report. And what I mean by that, and again, there are details in the OECD documents, but the data that are going into that CBCR must come from qualified financial statements. And qualified financial statements are those that are either the ones that feed into the group's overall consolidated financial statements, or they meet the requirements for the financial statement information that is described in the model rules on Pillar 2, right? So that is the first step that has to be overcome. And that's something that taxpayers are going to need to ensure if they're going to rely on the safe harbor, that their country-by-country reports do in fact meet the standard and the criteria for them to be viewed as qualified CBCRs. And again, a bit of an aside here, that is not necessarily a foregone conclusion, because in the past, for the original CBCR function, taxpayers have had the flexibility to rely on different sources of information that feed into their country-by-country reports, as long as there are certain consistency issues, etc., that are met. So again, I will emphasize that this safe harbor only works for a taxpayer if the country-by-country report that they're relying on meets the criteria for a qualified CBCR. Once that is done, though, then there are, for a particular jurisdiction to actually be eligible for the safe harbor, it needs to satisfy one of three possible conditions. As long as any one of those conditions are met, then the taxpayer can actually avail of that safe harbor for that particular jurisdiction, and then basically benefit from not having to do the complicated calculations and so on and so forth required for the Pillar 2 global information return for that jurisdiction. So what are those three possibilities? Well, the first one is referred to as a de minimis test. So based on the CBCR information, if for that taxpayer and for that jurisdiction in question, let's say country A, the revenue is below 10 million euros and the profits per the CBCR report is below 1 million euro, then nothing further needs to be done in terms of all the Pillar 2 computations. All they would do in the Globe Information Return for that particular jurisdiction is just show that they are availing of the safe harbor through the de minimis test. If that de minimis test is not met, then they could still rely on two other possibilities. The second one being a simplified effective tax rate test, which is, again, based on the free tax income as reported in the CBCR with a few minor adjustments, and the taxes shown on their qualified financial statement. If the effective tax rate based on that very, very simple calculation is no less than a transitional rate that is set for each year from 2024 through 2026 in this OECD document. It goes from 15% in the first year and goes all the way up to 17%. But as long as the simple effective tax rate calculated using the CBCR information and the taxes shown in the financial statement, the qualified financial statement, are no less than this transitional test, again, the taxpayer is good to go for that particular jurisdiction, and nothing further needs to be done in the Globe Information Return in terms of the complex calculations. And finally, there is the possibility that they can use the so-called routine profit test. Here, the information needed actually goes beyond the CBCR. But in a nutshell, what this test is, if the profit as shown in the CBCR is no greater than, remember, the substance-based exclusion that the Pillar 2 computation requires. That's a measure of so-called routine profits, because the top-up tax under the Pillar 2 rules is only applied to the excess income above these routine profits. But in a nutshell, if your profit as shown in your CBCR are no greater than the income calculated under the substance-based exclusion test, then you don't need to do anything further, and you can avail of this simplified safe harbor in your Globe Information Return, and you don't need to resort to the complex calculations needed in the Globe Information Return. So again, I've said a lot, but it is a powerful and a really good opportunity for taxpayers to actually take a number of jurisdictions off the table from the complicated calculations and data requirements of complying with Pillar 2 needed in the Globe Information Return, and in fact rely on the safe harbor for a number of these jurisdictions, albeit set for a temporary period. I will make an aside comment and observation as well, that as you can see, with its reliance on the CBCR, this safe harbor now uses the CBCR for something that goes well beyond the CBCR's original purpose under the original BEPS 1.0 project. And it is something for taxpayers to keep in mind when they're preparing the CBCR information, because the general trend now is definitely pointed in the direction of such CBCRs getting greater scrutiny than they have in the past. And we may not be actually too far off from the point where, that the rumors and the rumblings we've been hearing about public CBCR disclosures, etc., may become a reality. So again, a bit of a point as an aside, that more reason for taxpayers to pay significant more attention to their country-by-country reporting.
Thank you, Kartikeya. I want to pivot and ask both of you to give our listeners a quick update on what countries have taken steps to implement Pillar 2 and the likelihood of divergence in rule as countries adopt and implement domestic legislation. Giorgia, let's start with you, maybe focusing on the UK and Europe.
Thank you, Ugo. Yes, so many of our listeners will know that the European Union has adopted a directive on Pillar 2 in December 2022, and the directive on Pillar 2 needs to be transposed into national legislation by the 21st of December 2023, so this year. Some countries in Europe have published draft legislation, for example, the Netherlands in October 2022, Germany more recently on the 20th of March 2023. And the most advanced player is probably the UK, because the UK has published legislation on both the income inclusion rule and the qualifying domestic minimum top-up tax on the 23rd of March.
And the legislation is expected to be substantively enacted between June and July this year, so very, very soon. And in terms of divergences, we are already seeing some that are relevant for transfer pricing and for transfer pricing professionals. For example, the UK rules on the CBCR safe harbor do look a bit different from what we saw in the OECD administrative guidance. The UK rules, for example, refer to the accounts used to prepare the CBCR instead of referring directly to the CBCR when describing where to source the data, the figures for the calculations under the safe harbor tests. And there could be differences between the accounts that you use for the CBCR and what you end up having in the end in the CBCR. Probably the UK authorities will clarify this point and realign with the OECD guidance, but clearly, as worded, the legislation, the UK legislation, does raise some uncertainties. Also in the UK legislation, we see that for the CBCR to be qualifying for the safe harbor, it needs to be prepared in accordance with the OECD guidance. And this is something that is very familiar for our audience. And following on divergences, it's clearly that there are still quite a few open technical issues at the OECD, but at the same time, it's really unrealistic to expect countries to always go back to the OECD on those issues to agree on them with another 130 plus countries, some of which, let's keep in mind, will never implement Pillar 2. So we think that at a certain point, countries will have to tackle those technical issues unilaterally. At a certain point, the OECD process will become less relevant. And this is where we probably start seeing even more divergences than what we see today. And in this context, it's very important to note that the UK Finance Bill gives the Treasury, the UK Treasury, the power to issue regulations until the 31st of December 2026 for the purpose of ensuring consistency of the UK rules with the Pillar 2 rules. So the UK Treasury has about 2 years after the implementation of the Pillar 2 rules to issue further clarifications and further guidance. That's a long period where a lot of divergences could come in.
Thank you, Giorgia. Kartikeya, what is happening outside of UK and EU?
Yeah, sure thing, Ugo. And I'll keep it very, very brief, and I'll just mention a few. So we have South Korea that has actually enacted rules covering both the income inclusion rule and the UTPR. And in the South Korea case, these rules come into effect for fiscal years beginning after January 1, 2024. So that's a big development. You now have an example of a country that has this in its domestic legislation. We have Japan that has an outline for Pillar 2 legislation in its 2023 tax reform proposal. So here it's the IRR that would apply to fiscal years beginning on or after April 1, 2024. And then there are several other countries that are in various stages of consultation on this. So New Zealand, Malaysia, and plenty more. So short way of putting it, that this is a reality and it's happening, and taxpayers are going to have to deal with it very, very soon.
Thank you, Kartikeya. All right, so before we sign off, I want to ask both of you to give your takeaways and what we need to keep in mind and prioritize from a transfer pricing lens. Kartikeya, why don't you start?
Yeah, thanks, Ugo. And I will provide a bit of a high-level take here, and I'll leave it to Giorgia, as usual, to provide more of the specifics and the concrete aspects. But my take is one that is shaped by our experience with U.S. tax reform in the form of the TCJA. And prior to that, what was a fundamental change in the U.S. international tax landscape, I'm going to, at the risk of generalizing a little bit, but I would say that prior to that change, transfer pricing could operate in a bit of a compartmentalized manner. Transfer pricing changes had what I would call linear consequences in terms of the tax implications. And what I mean by that is that if you changed your transfer pricing such that the income in the impacted jurisdictions was like plus or minus 10%, then the tax implications were of similar orders of magnitude, plus or minus 10% relative to your starting point. What the US tax reform in post TCJA did was change all of that through the introduction of things like BEAT, GILTI, FDII, etc., where the impact of transfer pricing changes were no longer linear in the manner that I just described. You had now a number of ramifications and interrelationships that could combine to create very, very non-linear impacts. So-called cliff effects. So for example, if you had a change where to your transaction that may, in the grand scheme of things, be a small increment, incremental percentage of where you started out, you could suddenly find yourself crossing a threshold. So for example, think of the BEAT case, and you would be subject to BEAT because you were past that threshold, and you would have this type of a cliff effect or a nonlinear effect. And my sense is that what you're now seeing is a similar change in the landscape that transfer pricing practitioners will have to learn to navigate. A slight change in your transfer pricing might, for example, push you within or outside the scope of the safe harbor that we talked about, right? For example, via the routine profits test, right? A small adjustment after filing could introduce a number of those complications and interactions that Giorgia had talked about, and coupled with and combined with the other complexities that are inherent in the Pillar 2 rules, combine to create some very unanticipated and potentially unpleasant surprises in a Pillar 2 world. And so my high-level take in all of this is that it is going to be very important for transfer pricing practitioners to understand this very new and complex landscape, not necessarily in all of its intricacies and minutest details, but certainly in terms of the broad contours, and learn to operate within that landscape.
Okay, Giorgia, what about you?
Ugo, I think that my message would be a continuation of a Kartikeya theme, really. So I hope we have been able to convey to our listeners that there will be very important implications for transfer pricing coming from Pillar 2, and say that if we were thinking in terms of the top 2 priorities that you want to have in mind in the next, say, 3, 4, 5 months, really building on what Kartikeya was saying, the CBCR safe harbor, I would say that it's probably important to make sure that your CBCR is really aligned with your OECD Action 13 guidance, that the CBCR qualifies for the purpose of Pillar 2, so it's a qualifying CBCR, and that your CBCR doesn't get you out of the safe harbor because of some of the issues that Kartikeya has described, when instead you should be in the safe harbor. And this is very important also because the safe harbor has the rule of once out, always out. So if in one country for year T you cannot use the safe harbor, you will not be able to use it for year T+1 and year T+2. The second priority is probably to think about your year-end transfer pricing adjustments and if they flow through the consolidation pack or not. If not, the Pillar 2 compliance becomes even more complex, and you really might want to think about having in place a process that allows you to have an accurate and timely implementation of your transfer pricing policy within the consolidated accounting record. So those transfer pricing adjustments ideally should flow through the consolidated accounting records. And I think, Ugo, this is my main message.
Thank you, Giorgia and Kartikeya, for taking us through the Pillar 2 journey and the evolving role of transfer pricing. I also want to thank our listeners for joining us. We will be back in May with our next podcast. Until then, thanks for listening and have a great day.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.